And at Tradespoon, I'm going to give you a little background for myself. I'm the founder of Tradespoon. Today we're going to talk about option trading and stock trading and how to use key trading metrics, the return on capital, probability of success, and estimated move. And if you guys could do me a favor, if you can actually type in whether you traded stocks or options, and if you traded options specifically, how many years? Just tell me, so then I can get a feel of the audience, how many people we have, and how details we should get. Okay, Dan, Greg, Tim, thank you. Perfect. So we have people who traded options. Judy. Excellent. So let's get into this, and I think hopefully you guys find this interesting, especially if you're trading options. My background, I was the CTO of Options Express, started there the first employee. I worked at Media Ocean as a CTO and worked at several startups here in Chicago. I worked at Big Six hedge fund, and I worked at Aurora Investments. So my passion is trading. At Options Express, when I was the first employee, we were encouraged to trade. That was back in '99. So it's for the past 15 years I've been trading my own capital using stocks and options. For the past 15 years, I also been mentoring and teaching computer science classes. I have a master's degree in computer science, and I also been teaching Tradespoon subscribers how to trade stocks and options, and what are the key indicators when you're making a decision, when you get into a position, when you get out of the positions for trading. And I combine my technical experience writing algorithm and quant models, and I build a team of Tradespoon of traders who build quantitative models and try to look at the past performance of the stock, and also by utilizing quant models, try to see what is the future prediction of what is the likelihood of the stock being higher or lower in a certain time frame. So some of the disclaimers I want to make sure that we get a chance to read. Options do involve risk. A lot of the examples that I will present today are solely for general education and information purposes only. So I encourage you to look at the disclaimer. Also, I am and the team at Tradespoon might have a financial interest in some of these trade recommendations. So I just wanted to get it out of the way so you understand the risk involved with trading. So before I get into the discussion of probability of success, implied volatility, and return on capital, how to calculate this using options, I want to make sure that we understand common obstacles that you're facing as a self-directed retail investor. When I started to trade at Options Express, in the beginning, the issues that I found is how do you leverage capital? If you're trading stocks, usually you have limitations on how much money you can invest and leverage. On average, retail investors should have $10,000 to $20,000. That's the average stock or option portfolio out there. And if you're trading anywhere from 3 to 5% of your capital for any given trade, then you can only 5% of 10,000, that's $500. And if stock is trading at $100, you can only buy 5 shares. So you don't have enough leverage. Then the second issue that I face, which stocks to trade. There is only a certain amount of time you have in a day, so it's very hard to find quickly what are the best stocks to trade or what are the best options to trade. And you can buy Microsoft, but Hewlett-Packard might be a better profile in terms of likelihood of the stock being higher or lower, and what are the intrinsic fundamental value of the stock. The second issue that I found in a volatile market like we have been in the past 2 weeks, market moves very quickly and you are trading against institutional traders. Statistically, 95% of the time, institutional traders making money in a volatile market like we have right now. Retail investors, 95% of the time, actually lose money. So the issue becomes is that if you want to trade against institutional traders, you want to make sure that you have the proper tools and proper methodology. The problem with volatile market, as you know, if you're trading futures or options, is that market can move 2% down, 2% up very quickly. And unless you're doing this as a full-time job and you're looking every second at the screen, it's very hard to predict where the stock is going to move. So then it becomes kind of a chasing game where your stock or index that you're trading moved against you, and then all of a sudden you realize that you lost money because even though you're right on the direction of the stock or an index, and you might be right on the timing, but because of the short-term volatility, you get stopped out of your order, your stop order gets triggered, and then you are losing the money. And what do you do? How do you execute repair strategy? Well, as an when emotions take over your trading plan, you start chasing the market, and it becomes kind of a speculation game as opposed to a trading. And the one issue that I found that unless you have a specific trading plan, written down trading plan, where you document all of your decisions, why you're getting into the trade and why you get out of the trade, you tend to chase the market, and when you look, stock goes against you, you lose money, or index goes against you, you tend to double the money on a specific trade, and the emotions take over, and you tend to lose money. So at Tradespoon, we build a trading system that allows you to scan market and find the best stocks to trade. And we also calculate the probabilities using the different quant models of where the stock is going to be in the next 50 days. So I want to kind of show you quickly. So here's the Tradespoon site. If you're a Tradespoon subscriber, and you go under My Tools, View Tradespoon Bulls, we have the tools that allow you to see both the long-term rating of the stock, anywhere from 6 to 18 months, our horizon on the stock, and also the short-term trend of the stock. And scale, if the number is 9 through 10, that means we're very bullish on the stock, 6 to 18 months. And on the short-term trend, 9 and 10 also means that we are bullish on the stock. And if it's 8 or 9 or 10, that means there is a high probability of stock being higher in the next 50 days. And if you look at the, we get the best stocks for every sector. If you look at the alcohol and you click on Analyze, we're actually calculating probability of where the stock is going to be in the next 50 days. And we're specifying the target prices, $17 and $13. So we're going to go over how can you use underlying options data to predict where the stock is going to be at a certain time frame. And once you know the probability, you can take a trade using those odds. Another tool that is very interesting that I encourage you to look, especially if you are a day trader and you trade in futures and indexes. Can you type in yes if you can actually see my screen? Jack said that he cannot see my screen. Judy, yes, you can see my screen. Perfect. Okay, Dan, thank you. Very good. So yeah, if some of you don't see the screen, I would try to minimize the window and open the window again to make sure you can see it. But Trade Idea tool, if Tradespoon Bulls gets scanned on daily basis, Tradespoon Idea tool reacts to unusual options activity in the market. If there is an institutional buying inside of the options and implied volatility spikes, you can actually see large institutional movement. So I'm going to select volatility model. I'm scanning for implied volatility. My time horizon is different time horizons. My risk tolerance level is how volatile I want the stocks to be. 5 means implied volatility is 100% or over, and I click on Go. Let's say we think that the market sold off, and it right away finds you the opportunity in the market where implied volatility at a certain time frame has jumped. So you see time horizon 13, 35 days. This is the expiration cycle. 35 is a November expiration. 13, this is a weekly options that expires in 2 weeks. So I've seen that as Morgan Stanley announced earnings on Thursday and Friday, we see that the Citigroup spiked in implied volatility, and the unusual activity is in Friday expiration there 2 weeks from now. Not only that I know there is unusual options activity inside of this underlying at a certain time frame, I also have a conviction on the stock. I see that for Micron, my conviction is 10, long-term rating is 10, and I think that the stock is bullish. Short-term trend is 1, meaning that short-term the stock has been sold off due to geopolitical events and due to sell-off in the market. We know that the market sold off as high as 10% in the past week, so S&P is down 10%. It recovered on Friday, but we know that short-term, very quickly by running the scan, I know which stocks long-term are in uptrend, and short-term which ones sold off, like Micron. And then I can click on Analyze, and you can actually see what is the probability of Micron in the next 6 days. By the next Friday expiration, what is the probability of Micron being at level $24? And I know that there is only 2% chance based on the historical volatility, which you can see here. We're looking at one standard deviation move, and we're looking at the two standard deviation move. So there is only there's only 2% chance that based on the past 50 days, this historical volatility, that the stock will be at $23. And you might execute a strategy that if there is enough option premium at the heightened volatility, if there is enough option premium in the strike price 23 or 24, you can execute this trade, and basically you have 98% chance that the stock will be higher than this stock price. So that's the kind of technology we build in a Tradespoon. We're using quantitative models to assign a long-term rank for each of the stocks. So we have a conviction on the stock in case this trade goes against us. We can execute a repair strategy or withstand the short-term volatility. And we also have a forward predictive model, the short-term trend, that can tell us if 10, it means there's a high probability of stock being higher, and 1 means that there's a low probability of stock being higher. So our sweet model is 50 to 70 days expiration. This is the expiration cycles that we're looking for. So right now we would look in December expiration, and on average we're waiting for 20 to 30 days to close our trades. Our trades usually last 20 to 30 days. We do have a trade idea tool that I showed you a second ago, and that looks for implied volatility in weekly options. So if you are a day trader and you like to trade weekly options, that's the perfect opportunity to find stocks that have spikes in short-term spikes in implied volatility and find what are the long-term and short-term signals in terms of probability of where the stock is going to go by the expiration date. So our approach is looking at the macro and microeconomic conditions. We want to see where we are in the stock market, and if you look at the stock chart, and we're looking at the daily chart here. Let's see if I can draw. So you see that how the S&P, if you look at the daily chart here, that the market has been sold off. And if you're a day trader, that picture might not be that important to you, but you, as a day trader, you should see that if you look at the Bollinger Bands and you're looking just at mathematics, you're looking at the two standard deviation move, which is, what does a two standard deviation move means? This is the outliers. It means that 95% of the time, if you look at the historical data, for the past, just looking at the formula for standard deviation and how the price behaved in the past, 95% of the time, and you can use this whether you're doing day trading with options or if you're kind of more of a midterm trader, but 95% of the time you know that the stock will be between these Bollinger Bands, and 95%. And 5% of the time we see these outliers, which happened in the past week. For 6 or 7 days, you've seen that the stock index, S&P 500, closed below the lower band of the Bollinger Bands. And I'm looking at the 50 days till expiration. As a trader, and you look at the charts, you have to look at the proper time horizon. If you're a day trader, you might want to look at the 5 days to 15 days. If you are a midterm trader, then you can look at 10 days and 30-day chart. But no matter what the time horizon you look, and it should be appropriate to your trading style, the statistics apply. You still need to look at two standard deviation away, and if you see moves that are either one standard deviation away or two standard deviation away, this means they are outliers, and most of the time you do see the moves to the opposite direction. That's what we kind of saw here on Friday. We've seen that the market has rebounded back to the upper side of the Bollinger Band, and most likely, next week we will probably test this 50 days, 50% retracement at 1920 level, if you look at the retracements level, Fibonacci retracements here. So technical analysis is very important, and we are trading. When we are trading, how is the sound now? I'm sorry, Judy and Lee, you said that you lost the sound. Type in yes if you can actually hear me. I just want to make sure that it's not kind of a system-wide issue. But if you can hear me, type in yes. Perfect. Ari, Judy, yes. Great. Thank you. Appreciate that. So the first thing is important to look at the Chase. Thank you. Perfect. I'm glad you guys can hear me. Let me just erase some of the drawings. So once we look at the macro and microeconomic conditions, we look where we are in the earnings cycle. Is there a binary event ahead of us? We're trying to create a watch list. So once we look at the macro and microeconomic conditions, we need to find the watch list. And running Tradespoon Bulls or running a Tradespoon idea tool allows you to find the best stocks in any given sector. Then we're applying our forward-looking forecasting system, the short-term rating, to see which stocks are poised to be higher in the next 50 days. So now we want to jump into how to calculate probability of success versus the return on capital. That's going to be the topic. So how many of you have traded option spreads or know how to, trade, or you were selling options volatility in the past? So Judy, Green, perfect. Harry, Michael, thank you. Great. So if you traded options before and you've traded, oh, some of you are from Options Express, perfectly. Yes, I've spent a lot of time at Options Express. And you can actually see that the screen is shot from Options Express. But at Tradespoon, we are selling the options volatility using option verticals. So we're trying to find one simple strategy to follow. And we're also trying to find a strategy that if the market goes against us due to short-term volatility, we don't get stopped out. And the most conservative approach is vertical spreads. So we're buying same expiration months, calls or puts, and we're buying strike price that are either 2 points apart or 5 points apart, depending on the underlying price. So you're looking at the screen, and this is stock is, and we're looking at the Apple, and Apple I think closed at $98 on Friday. So you're looking at the bullish chart of the Apple using the vertical spreads. So if you're using the vertical spreads, what it allows you, if Apple goes to 80 short-term or it goes to 110 due to short-term volatility, you still have time until the expiration. Let's say you trade in November options, or you trade in, or if you trade in 200, or if the stock goes to $80 or to $110, you know that if you buy the option spread at $90, $95, you will not get stopped out of the trade. So it's a perfect instrument, perfect strategy to withhold short-term volatility, and this is why we are advocating to trade it using option spreads. So there are two things you see on this chart. One is the profit and loss chart. If you see the Apple stock going in this direction, and on the x-axis you have strike prices and the Apple stock price, you see that the stock is going, as it's going up, your profit also increases. And when you do strike prices selections, you want to make sure that the probability of success for your spread is within the 68% range. So this, if you look at this bell-shaped curve, this is a 68, this is pure statistics, going back to math courses and statistics courses. That's basically meaning that the probability of Apple being at $80 is very small, and probability of stock of being at 100, at 115 or beyond is also relatively small. And these are outlier events that might happen only 5% of the time, because if the move is beyond 2 standard deviation. But if the move within 1 standard deviation away, then there's a 98% probability to be higher. And the criteria that we're, and John, I'll make sure that I'll address all these questions. Let me try to finish my presentation first, and then I'll go back and address some of your questions. But the way I know whether I'm bullish on Apple or not, I basically look at the Tradespoon Bull. So if I go and I look at Micron, let's look at the Apple. Let me just erase my drawings. So one question is, how do I know which, if we are bullish on the stock or not? So I go to stock focus list, I type in Apple, I click search, and then I look probability. So according to our quant models, our long-term rating is 10 on Apple, and our short-term rating is 7. So long-term we're bullish on the stock, and short-term we think that the stock will outperform the market in the next 50 days. This is our sweet spot. So then we look at the historical volatility, and we're seeing that one standard deviation move for Apple is between 90%, $90 and $106. So if that's the case, then we are selling the option premium, and we're bullish on this trade. So we will sell a 90 strike price. So we would sell 90 strike price or 92 strike price for Apple, and we would sell a put. If you're more aggressive trader, you would sell naked put at $90. If you're more conservative, you would sell the 90 put, and you would buy 85 put to hedge yourself in case stock does move 2 standard deviation away, which we've seen that several times in the past 2 weeks. 50 days is something that we provide in services at Tradespoon. If you look under my tools, the premium picks and elite picks, they're all based on the 50-time horizon. And we are closing our trades when we reach our target level gains, anywhere from 30 to 40%. Then we close our trades, and usually our trades last anywhere from 20 to 30 days. And yes, the beauty of this, some of you, Arthur asked a good question, earnings, Apple is about to announce earnings, and it's true. This is a historical volatility, but we also use implied volatility. So these probabilities that you're seeing on the screen, 21% probability that Apple will be below $90 is based on the demand and supply and option prices for December expiration, because we're looking now at December expiration. So we're looking at the prices of puts and calls at the money, and we're using binomial equations to figure out what is implied volatility and what is the probability of Apple being at a certain price level in the next 50 days. Once you figure out that there is a 21% probability, that means if you're selling 90 put for Apple, there is 80% probability that you will be right. So that means 8 out of 10 times historically you will make money. And those are the great odds if you trade in options, because if you trade in anything else, if you trade in futures or you trade in ETFs, you basically have 50% chance that you're going to make money. Stock can go up, or index or currency can go up, or it can go down. Yes, you can look at the technical indicators, but ultimately you can improve your odds beyond 50%, but other than options, the odds are always 50-50. If you want to increase your odds, you have to basically move away from the current market. And that's the beauty of the options, is that you can actually improve your probabilities of success, because Apple is at close at $98. So Apple has to drop $8. Apple has to move $8 before you're actually going to lose your money. And that's why your odds are higher than 50%. And in this case, if you sell 90 put, your odds are at 8% that you will make money. So probability of success is a very important measurement. It's done using options data. It's using binomial equations to figure out where the stock is. You can definitely look at other options that we're following, any stocks that have underlying options data, and you will be able to look at this probability calculator. So this is a great tool to leverage your capital and find trades where your probability of success is greater than 50%. Options sometimes do have a bad reputation between traders, because you will see that a lot of people would say that 90% of the trades you actually lose money on options. Why? Because people tend to buy cheap options, out of the money options. So if Apple trades $98, people would buy 106 call before the earnings. And that's fine, but the problem is stock has to move between $98. If the stock is here, it has to move all the way to $106 to you to make money. And yes, Apple is about to announce earnings, and there is a binary event, but the Apple has to jump by $8, more than 10%, for you to start making money. So if you're taking this approach and you buy at 106 call, yes, you're statistically looking at the statistical data, looking at the historical implied volatility, looking at the implied volatility that shows you the future prediction where the stock is going to be based on underlying options data for December expiration, there's only 17% chance that you will make money. So that means 8 out of 10 times you will lose money. And this is why 90% of the time people trade options and lose options, especially if they're a beginner. So buying out of the money options, especially when the implied volatility is high in relative terms, you're basically betting against yourself. And if you want to improve your odds and improve your odds of winning at the time of heightened implied volatility, and we're going to go to that shortly, when the implied volatility relative to its historical implied volatility is high, you always want to sell premium. If you're new to options trading, don't sell naked, because we've seen at the chart here, if you look at this chart, let me draw here. Just want to go back to the chart to make sure we're seeing what know what we're talking about. Sorry. One second. Just wanted to refresh my screen. So yeah, if you look at this chart again for SPX, you can see that outliers do happen. So you've seen that the stocks do tend to move 2 standard deviation away. So even though you bet that the S&P will not reach 2 standard deviation away, but for the past week, 7 times it actually moved 2 standard deviations away. That means that even though your probability of the trade was 90%, you still lost money. So you want to make sure you hedge yourself by doing not only selling the naked options, but you are doing the spread. You're selling in the case of Apple, 90 put, but you also buying 85 put in case volatility is increased and VIX goes from 25 to 40, which might happen. Then probability is relative terms, you might lose money, so you want to hedge yourself. But if you're a more experienced trader and you know how to adjust your position and know how to fight for your positions level and wait for this rebound like we had on Friday, then you can sell naked put, and if the stock goes against you, you can execute a repair strategy. You can roll the spread down, or you can roll the option to the next month. You can execute a repair strategy, especially if you're a day trader. Then you can sell naked puts. But otherwise, we encourage you to trade spreads. So looking at these probabilities and looking at the probability of success, kind of the only way to improve your odds of trading is by selling out of the money options. And when implied volatility is high, you want to sell either naked options or do verticals. Those are the best strategy in the market for this market conditions. And this is something that institutional traders love to trade in the past 2 weeks, and they're making a lot of money because they basically look at the probabilities, they know how to hedge their positions, and they are trying to be delta, market neutral, sell both options 2 standard deviation away, and sell calls. So you can sell naked calls, you can sell 90 call, you can sell 106 call for Apple, you can also sell 89 put for Apple, make it market neutral, and collect premium on both sides. And unless Apple moves 2 standard deviations away, you can make money. So this is the chart for the spreads, and at Tradespoon we provide you with daily recommendation. You get 1 recommendation a day or 1 recommendation a week where we find the best stocks in the market, and we also giving you probabilities of where the stock is going to be and execute either bullish strategy or bearish strategy. So for Apple, because the long-term conviction was 10, because of the long-term conviction was 10, we are executing bullish strategy. We're doing a bullish put spread. And let me draw my pen again. So the idea is that for Apple, since we're bullish on the stock based on our proprietary rating, we want to execute bullish call spread. This is one choice if the implied volatility is low, but implied volatility in relative terms today is high, so we're executing bullish put spread. And bullish put spread means that we are getting a credit. We're getting a credit up front, and we're selling, as we said, 85 put. So we can sell the 85 put. Sell the 85 put. And to hedge ourselves in case we are wrong and the market goes against us, we would buy 80 put for protection. And the reason we're doing selling the put spread instead of buying the debit call spread is because of the relative to where implied volatility of Apple now to historically it's increased. And the opposite can be for bearish case. Let's say we have also bearish stocks. The profit loss chart will be the opposite. It will look like this. And in this case, we would execute bearish call spread, we would sell the call spread, and we would buy debit put spread. So let's erase this data. And I'll make sure that towards the end, I'll make sure that I answer all of the questions. So stick around. Okay, so we talked about probability of success. Here we're looking at the Alcoa. Alcoa is trading at $16. Looking at the probability of success and looking at the implied data, the bid and ask of options data that already factors all of the earnings data, you can figure out what is the probability of success of stock being at a certain price level. And that helps you with the strike selection. Then we look at the IV rank. So IV rank, IV rank gives you an opportunity to decide if you're bullish on the stock or you're bullish on Western Digital. This is the graph of implied volatility. Do you execute debit spread? Do you buy a debit call spread? Or do you sell a credit put spread? And the way you know this is basically looking at the graph of implied volatility. So for graph for implied volatility, you basically look at the past 52 weeks, the blue line is implied volatility. You find the lowest point, and you find where implied volatility now. And this is October 1st. Now implied volatility of WDC is probably somewhere here. So if implied volatility is high relative to where it was below, and we're talking about 50%, and the way you just do it is say that what's the lowest point, 20, and what's the highest point, 45. The difference is 25. Where implied volatility now, the change, and implied volatility lowest was at 20. So if the change in implied volatility is above 50% in relative terms, that means you want to sell premium, you want to sell credit put spread for WDC if your conviction that the Western Digital will outperform the market by the time frame. If that's your conviction, you want to sell premium, you want to sell put spread. On the end of September, when implied volatility was here, it was low. You want to, instead of selling the premium, you want to buy debit spreads. You either want to buy a call or you want to buy a debit call spread. And the reason is implied volatility, like anything, reverts to its mean. You can see for all of the stocks, implied volatility goes up and down, up and down. Why is it going up and down? Well, it's earnings seasons or geopolitical events. Before the earnings, if you look at the implied volatility expands, it becomes higher, it goes this way. Why? Because at this time, this is where we have our earnings announcement, right? Right before the earnings announcement, people are hedging their positions, there is a lot of demand for puts, and implied volatility increases. As soon as the earnings are announced, the next day, implied volatility collapses because there is no anticipation of any binary event, and implied volatility collapses. Now is actually a perfect time to trade options because stocks announce earnings, Alcoa announce earnings, but implied volatility still increase. So you already know if the stock beat the estimates or not, and you already have a conviction on the stock, but implied volatility is still high because of the geopolitical events and instabilities in the market. So it's a perfect opportunity if you're a conservative trader and you have enough cash in your portfolio to start selling the volatility of the underlying stocks. Because implied volatility is high, that means you get a lot of premium for selling 1 or 2 standard deviation away options. So let me erase my drawings. So looking at the implied, so if you're new to trading or if you're trading options and you haven't looked at implied volatility before and probability of success, before you trade options, this is something you need to do. And I know that myself, I lost a lot of money when I started trading. And the reason is I never looked at implied volatility, and I never looked at the probability of success. I was buying out of the money options because they were just cheap, and I did not know whether to buy options or sell options, and when is it appropriate. If you're selling options when volatility is low, you're just not getting enough premium for your money, and most likely when volatility expands, even if the stock didn't move, you lose money. If you're buying options when volatility is high, that means that there's already a lot of premium in the options, and as soon as the binary event passes, implied volatility collapses, and all of a sudden your options loses all of its value. So if you're an option trader, you have to look at implied volatility in its relative terms, now versus historically 52 weeks, and you also look at the probability of success based on the statistical analysis. So here is the Federal Express that we recommended on September 25th. We looked at the probability of success. That for each of the trade, we provide you probability of success, 66%. And one might ask, why are we not always trading probability of success 80%? Well, the reason why we're not always why not always trade options that are 2 standard deviations away? Well, the reason why you don't want to trade options that are 2 standard deviations away are because you might not get enough premium for options. Right now, you can trade options that are 2 standard deviations away because VIX is high, that's at 25, and you can get a premium for your out-of-the-money options. So the key point here is how do you calculate probability of success? POS stands for probability of success, versus return on capital, which we're going to calculate shortly. I'll show you how to calculate return on capital. But basically, there is no magic. If the probability of success is high, that means return on the risk or return on your capital is low. And it might sound trivial, but it's very important to understand. So if probability of success increases, then return on capital decreases. So here, when you calculate, when you do in your journal and you record in all of your trades, you have to make sure that your probability of success, if you want it to be higher, that's fine, but that means your return on capital will be lower. Even if the stock goes against you, you will lose money. So if probability of success is 90%, that's great, but it also means that you might only get 10 cents on the dollar that you're risking. So if you're right, and the stock will not move beyond 2 standard deviation away, then you will make 10 cents. But if you're wrong, you might lose up to 90 cents or even more from naked options. So you have to be comfortable with the risk you're taking. And I'm going to shortly explain what EM is. EM is estimated move. I will cover this shortly. But probability of success in return on capital and this volatility change, kind of this IV ring that we covered shortly, is a very important number that you have to document before you get into the trade. And as you get more experience, and most of the institutional traders, they are looking for at least 90 to 80% probability of success. The trading out of the money options is very popular right now because they are comfortable. They want to take high odds trades, but they are also proactive in managing their positions if the stock market goes against them. So
hey, Vlad, don't mean to interrupt, but you got about 5 minutes left. I just want to give you a heads up.
Perfect. Thanks a lot.
Thank you.
Thank you. So probability of success in return on capital is extremely important and is something you have to keep in mind. So since I have 5 minutes, let me try to finish my all my questions. So the last question was return on capital. So return on capital. How do you calculate return on capital? That's maximum gain versus the maximum loss. For credit spread, maximum gain is the difference between the ask of the buy leg and the bid of the sell leg. So here's the credit spread. We're selling 70 put, and we're buying 67.5 put. We sold it for $1.90. We bought it for $1.10. The difference in price is 80 cents. So that's your maximum gain. And for Tradespoon, for every trade, we provide you with the trade recommendation. So your maximum gain is 80 cents. Your maximum loss is $1.70. It's 80 cents over $1.70. And this is how you calculate 47% return on capital. That means for every dollar that you're risking, you can make 47 cents and you can lose 53 cents. Why? Because why you structure trades that way? Well, the reason is because we are not we want to have a probability of success greater than 50%. If you're looking at the here, probability of the success is 60%. That means that stock has to move beyond one standard deviation in order for you to lose money. So this is a formula for credit spread. The maximum loss is the difference in strikes. 70 minus 67.5 is $2.50. So you divide $2.50. You take $2.50 minus the credit that you received. That's your maximum loss, $1.70. So I got $1.70 by taking the 2.5 strike difference minus the credit that I received. That's $1.70. So if I divide my maximum gain by maximum loss, that's how I got the return on capital, 47%. If you do the same thing for debit spreads, the debit spreads means you're paying for the debit up front. This is the same calculations. What is your maximum risk? Well, that's the debit that you're paying up front. Your maximum risk is the debit that you paid up front, which is the ask of the buy leg minus the bid of the sell leg. In this example, $6.50 minus $3.80. That's $2.70. So maximum gain is $2.30. Maximum loss is $2.70. You divide that and you get 85%. If you guys, I know I'm kind of running out of time, so I'm going to type in my address in case you guys do have a question, so you want to have access to this recording. You can just type in Vlad at Tradespoon.com. Just shoot me email. I'll be able to give you an access to the recording or explain these slides in more detail. But for the debit spread, your maximum loss is the debit that you paid, so difference between the sell leg and the bid leg, and the maximum gain is $2.30 divided by 270. That is the 85%. That's your maximum return on capital. And finally, we want to calculate math behind the estimated move. Estimated move gives you ability to predict the range of where the stock is going to be by the expiration date. So, and the way you do this, you do it at the money strangle. So you take the ask of the put, which is in here 37 cents, and you take $1.01 at the money. Assuming that Alcoa is trading at $16, you take $1.01 plus 37 cents, and you divide this, and you also add the out-of-the-money put, 49 cents. Here's the bid for out-of-the-money call, and the 14 cents for out-of-the-money put. You add these four numbers together, divided by 2, 95 cents, meaning that between now and the expiration date, based on the implied volatility of the option, the stock will be between $16 plus 95 cents or $16 minus 95 cents. So, and that's the estimated move. So here, what we're offering is both premium picks and the elite picks. And for every pick that we provide, let's say Mattel, we are giving you volatility change. We see that implied volatility of Mattel is high after its earnings, still high. Return on capital is 52%, probability of success 65%. Estimated move is $1.90. That means between now and November expiration, Alcoa will be somewhere between $29.62 plus or minus $1.90. And this is now how you know what the range of the Alcoa will be, Mattel will be between now and November 22nd expiration. And we are selling premium because implied volatility is high in relative terms. So we sold the 30 call, we bought 32 call, and probability of our success is 65%. We're providing you with the chart with Fibonacci retracements and key technical indicators so you can see how Alcoa sold off. So, and we're betting that Alcoa will not retrace beyond 30 and 30, somewhere between this 32% retracement. We also provide you with a probability calculator where you can see that our long-term conviction on Mattel is 1. Our short-term Mattel has bounced back, so we see 10. So this is a perfect opportunity to kind of go short and sell short the stocks. We provide you with our news and commentary why we made this recommendation and all of this historical earnings. So if you guys want to have access to our Tradespoon bulls and Tradespoon bears, if you open up an account, if you want to see the best stocks and rank them, find the best stocks or the worst stocks or the stocks that are kind of trading in the channel, if you want to have access to our implied volatility tools and trade idea tool that searches for spikes, institutional buying in any given underline, we do have a special deal that I will type in here. So for $67 a month, Our regular price is $97 a month, but for everybody who's on this webinar, we're providing 31% discount. For $67 a month, if I'm going to type that in, and just let me know if you guys see the deal. If you go to tradespoon.com/deal, this is available only for webinar attendees. We will slash our prices by $30, which is 30%, and for $67, you get access to our premium portfolio, where we provide you one trade recommendation a day, or our elite portfolio, where we provide you one recommendation a month with specific entry prices and exit prices, probability of success, implied volatility changes, and commentary. We also have access to our trade idea tool. You have access to our Tradespoon bulls and bears list. We have a video library where we provide a training. Every week we have anywhere from 3 to 4 live webinars where you can learn some of the concepts we covered here today. And we also have a live broadcast where and the recordings where we provide you not only trade recommendations but the commentary of the market and any other ideas. So some of the questions: is your performance on IBD leaderboard? We do have a performance. We're not on IBD. I'm not sure what an IBD leaderboard. I assume you're referring to Investors Business Daily, Sandy. But if Investors Business Daily, we do record all of our trades. So we're very transparent. Every trade that we've made since 2012 has been recorded. We're averaging about 68% winning rate, and right now we're averaging 20% return per trade across winners and losers for our premium performance, and elite performance is for elite performance we are averaging 25% return per trade. We also have backtests where if you backtest our performance since the inception, you can see if you open up account with $10,000, by now it will be $20,000. So about 100% return in 2 years if you follow every single trade that we make. And we've been averaging 20% return. If you look at this here, I actually put down.
Hey Vlad, we're looking at just under a minute right now.
Under a minute, perfect. Thanks a lot. So I'm going to wrap it up. Assuming that you have $10,000 portfolio, you should never allocate more than 5% per trade. It's the $500, and average holding time is 30 days. Assuming return 20% return, that's kind of our trading plan at Tradespoon. If you do 50 trades, you can make up to $5,000. So 50% annual return if you trade once a week. So again, I encourage you, do me a favor, encourage you to take a look at, visit our site, take a look at our deal. If you want to learn, if you trade in options and you want to find these high probabilistic trades, there's no commitment. You pay each month. You get access to our technology and also our trade recommendation and our training where we have 2 to 3 webinars a week. So Tradespoon deal, and let me try to see if I can answer some of the questions. It's only have under a minute. What's the best way to take advantage of our program? Sign up, click on enroll, sign up here, and follow. If you trade on daily basis, then you would have access to our elite premium picks, one trade recommendation a day. If you're new or you haven't traded options before, we would recommend following our elite picks, and you would get one trade recommendation months, and to get comfortable with options. If you're already traded options before, Trade Idea tool is a great tool to actually scan for market volatility. And if you see any trade stocks that you're comfortable with trading, like Apple or Dow, you just click on Analyze. This is real-time scanner that looks at spikes in applied volatility real time. You click Dow Chemical. Let's say you know Dow Chemical, you're comfortable with this. Click on Analyze, and if you traded before, you can sell 41 put, or you can sell 40 put and 35 and buy 35 put for protection. You have a long-term conviction of 9, so you know long-term stock is an uptrend, and you know that short-term Dow is been under pressure. So if you feel comfortable based on technical analysis that it will rebound, then you can take the trade. So there's different ways of utilizing Tradespoon. You can either use our analytical tools, or you can follow our trade recommendation with specific entry and exit prices, which is also for every trade that we are providing. Let's say, let's look at Mattel. here.
Vlad, I'm sorry to cut you off, but we are out of time right now.
All right. Reed, thank you very much for having me. This has been a great time. If you guys have any questions, send me an email at vlad@tradespoon.com, and good luck trading. Thanks again for having me.